Are you an established small business owner or aspiring entrepreneur? Would you like professional advice to help your business grow and succeed? Well, look no further. The Virgin Islands Small Business Development Center is the territory's #1 resource to move your business forward. Enjoy no-cost advising, low-cost training, and technical assistance from experts in both the public and private sectors. The VISBDC is nationally accredited and sustained by the University of the Virgin Islands and the U.S. Small Business Administration. Visit us at our locations on St. Thomas, St. John, or St. Croix, and follow us on social media at VISBDC. For easy access to all our training and networking events, be sure to join our newsletter and download the VISBDC app. The Virgin Islands Small Business Development Center, here to help your business start, grow, and succeed.
Good morning, everyone, and welcome to the VISBDC's hosting of Small Business Accounting 101 with Merchants Commercial Bank. Today's webinar continues the VISBDC's focus on April being Financial Literacy Month. We have put together essential training opportunities that educate both entrepreneurs and small business owners in getting their personal and business finances in order. This session focuses on basic accounting terminology, the differences between the cash and accrual accounting methods, becoming familiar with accounts payable and receivables, and much more. Allow me to introduce today's presenter. Currently serving as president of Merchants Commercial Bank, MCB, Valdamier Val Collens provides leadership, strategic direction, and management of MCB's commercial loan portfolios and deposit operations. He offers more than 30 years of leadership and sustainable changes in processes, systems, fiscal management, auditing, compliance monitoring, and information technology in the private and public sectors. Mr. Collins earned his MBA from Harvard Business School in 1998 and has been a New York State certified public accountant for more than 25 years. Mr. Collins is a native of the Virgin Islands and has resided in St. Thomas for the past 20 years. Allow me to introduce our second presenter. Annette Williams is the Vice President and Chief Financial Officer of Merchants Commercial Bank. In this role, she is responsible for the overall financial management, planning, and analysis. In addition to her CFO duties, Ms. Williams also oversees the bank's audit, compliance, and BSA departments. Ms. Williams brings more than 30 years of banking experience to the management team of Merchants Commercial Bank. Previously, she served as the Vice President and CFO at First Virgin Islands Federal Savings Bank for 13 years. Ms. Williams has held many positions in her banking career to include Chief Financial Officer, Loan Servicing Supervisor, Compliance Officer, Audit Officer, Deposit Operations Officer, Information Technology Officer, Accounting Manager, and Bank Security Officer. In addition to her professional roles, she is also an active member in the community, having both served as a member in various leadership positions for community organizations to include Rotary Club of St. Thomas II, Iota Phi Lambda Sorority, the treasurer of the Memorial Moravian Church as well. Ms. Williams holds a Bachelor of Arts in Accounting from the College of the Virgin Islands and has been a certified public accountant since 1990. Here's a friendly reminder to put your questions in the chat, and they will be addressed by the presenting team either in the chat or later during the question and answer segment. A copy of this presentation is available upon email request to training@visbdc.org. We encourage you to take a few minutes after this training to fill out the survey that lets us know how we're doing. So without further ado, President Collins, the floor is yours.
Okay, thank you, Ms. Industrious, and welcome everyone to Accounting 101. Again, my name is Val Collins, and I'm the president of Merchants Commercial Bank. And what we'd like to do today, myself and Ms. Annette Williams, is just to provide you with some foundational concepts around accounting. My experience has been, as Ms. Industrious stated, has been across the board, from auditing, from information systems technology, from managing a trading floor, and now at a bank. I've also been in government for a while. So one thing about accounting is that it gives you the opportunity to work across a lot of different sectors. And I hope many of you may pursue a career in accounting if that is something that you are interested in. But I think today is all about how do you understand the basic concepts of accounting to run your small business. So how we structured today's conversation is to basically talk to you about the standard formula that we believe that is important for your understanding of accounting. And then we'll talk about the components of a balance sheet: assets, liabilities, and equity. We'll then move on to the income statement, and then transition into the different ways in which you can report your accounting: accrual versus cash basis accounting. We'll follow the conversation and delve a little into accounts receivable, accounts payable, talk about how the basic entries in an accounting system using journals and a general ledger will lead to a balance sheet and income statement. And then finally, we'll close out with some concepts on budgeting, payroll, and external auditing. So again, welcome to Accounting 101. As I indicated, the first topic that we would like to really help you to understand is the basic equation of accounting. And that is, assets must always equal your liabilities and your equity. This equation really helps identify the relationship between all of the crucial elements of accounting. What you'll see later on as we go through is, although that this is the main structure of a balance sheet, the income statement makes its way into the right side of that equation on the equity side through retained earnings. And I'll go into that a little bit when we get to that slide. So shifting to the balance sheet, the first major component is your assets. Now, your assets are the things or property of value that you own, a lot of which you can actually touch because they're tangible. However, there are some instances where you may have some intangible assets as well. So to think of some of the tangible assets, obviously most businesses have to start with cash. That's the most tangible asset. And of course, you'll have equipment, as part of your asset structure. If you're in the business of selling goods, inventory may be part of your assets as well. And if you're lucky to start a business and own a building, well, of course, that will be an asset as well. Examples of intangible assets will be things such as patents, trademarks, and goodwill. So the key thing about the assets is that they are the things that are going to allow you to generate revenues and profits for the business. So of course, if you own inventory, those are the things, that particular asset is what you would be utilizing to sell goods and reap profits, which would essentially make it to your profit and loss, and then back to the balance sheet. The assets are also key indicators of your financial health. If you have more liabilities than you have assets, that that would not be considered a healthy organization. But oftentimes that is not the case unless there's significant stress in your business. Another thing is that assets are it helps you save money and set things aside for emergencies and future goals. And so those are just a few examples of the assets that you might see on your balance sheet. Moving on to liabilities. So what is a liability? So a liability is an obligation or debt that a company owes to outside parties. So if you're in the business of obtaining goods on credit from a vendor that you're doing business with, that would be considered a liability. Another type of liability is a loan. So a loan obviously is a liability that you would owe to a bank or some other financial institution. Sometimes individuals may, or owners of a business may write a note payable to an entity to obtain funding to continue their business, and a note payable would be yet another example of a liability that you would see on a balance sheet. So far we've talked about assets and liabilities. And again, going back to the original formula, your assets always have to equal your liabilities and your equity. So let's look at what equity is. So equity represents the ownership interest in the company. So after you take your assets and you subtract out all of your liabilities, what's left over is what's called the equity in your company. So when you first establish your company, a key component of the equity section is going to be the contributed capital. So for example, if you opened up your business with $1,000, you would have $1,000 in cash, no liabilities, and the other 1,000 would be your contributed capital. And as you could see, the 1,000 in cash, which is your total assets, would match your the other side of the equations, mostly on the equity side, by virtue of the contributed capital. The other component that I mentioned is retained earnings. So retained earnings is on the equity side, and what that does, it accumulates all of the profits and or losses that the business incurs. And so in your first year of operations, if again using the $1,000 in assets and the $1,000 in contributed capital, in your first year of business, if you had net income of say $50 after taking away revenues minus expenses, that $50 in net income would be an accumulated profit that would make its way over to the retained earnings side of the balance sheet. So, some key things to note is that the equity side shows how much the company's assets are owned by the shareholders, and it changes when there are investments by shareholders, such as you may want to pay yourself a dividend if things are going well in your organization. That obviously is going to reduce, well, it's not so obvious yet, but it will reduce your retained earnings if you choose to pay yourself dividends. But again, that's if you have accumulated profits that are retained in the business. So let's take a look at what this actually looks like. So in this example that we have here for Paul's Guitar Shop, as of the year ended December 31st, 2024, which hasn't occurred yet, you can see this company has total assets of $1,998 dollars. And that's based on the information, total current assets of 999 and total net fixed assets of 999. Going back to the fundamental concept that the assets must always equal total liabilities and equity, you could see on the opposite side, on the right side, that the liabilities and the equity equal the assets at 1,998. And the liabilities, as you can see, the liabilities is just the total of the 1,239 and 93. And then the shareholders' equity is a total of the capital stock, paid in capital, and retained earnings. So this is what a typical balance sheet may look like. You may not have all of these categories, subcategories that you see here, but we just wanted to give you an idea of what a balance sheet would look like. So just to summarize again, so the balance sheet, it reports your finances as of a specific date. In the example that I just provided to you, that was as of December 31st. So it's as of. It also reports your assets, liabilities, and your equity position as of a particular point in time. And as discussed, it's really used for you to make decisions to see if you have enough assets to satisfy your financial obligations, which essentially means your liabilities. So now let's move on to the income statement, because as I indicated, they work hand in hand with each other, because the net income or net loss from your income statement will flow to the retained earnings section of the balance sheet within the equity component. The income statement or profit and loss or statement of revenues and expenditures, it comes in a lot of different terms, but all it primarily does, it reports your revenues and expenses over a period of time. So whereas your balance sheet is as of a specific date, your income statement will run through a period, say from January 1st to March 31st, or January 1st through December 31st. So it's through a period of time versus the balance sheet, which is as of a specific date. As I indicated, it reports your revenues and your expenses, and it simply helps you to evaluate whether or not your company is profitable or not. And it is a key. Both of these documents are key when approaching a bank for a loan. And so, and one thing I want to say to you is there are a multitude of programs out there that can provide you with a balance sheet and an income statement at a push of a button. The most common program that's out there is QuickBooks. QuickBooks is a great program. We've seen small business, medium-sized business, and large businesses utilize QuickBooks to manage their financial reporting, to help them make decisions about their business. So when we get into the finer components of the journal entries and the general ledger, a lot of that is already being done for you once you invest in a program like QuickBooks. But it always depends on the kind of the information that you put in. If you put in good information, you'll get good information from your balance sheet and income statement. But if you're putting in transactions that don't make sense, the balance sheet and income statement will be inaccurate. So let me give you a visual of what an income statement looks like. Again, we're back to Paul's guitar shop. And this is essentially what an income statement is going to look like. It's going to have your revenues. It may have some subcategories, like the main type of sales for this is selling guitars. So that's what, 24.8. And then in this business, he also does music lessons. So he was able to accumulate about 3,000 there for a total revenue of about 27.8. And from those revenues, you subtract your total expenditures, which in this case, when you add up the cost of goods sold and all the other expenditures that you see listed here, you get a total expense item of about 14.8, 14.9. So the net profit, when you take the revenues of 27.8 and the total expenses of 14.9, is the net income for this business for the period ending December 31st. So in this case, Paul made a total net profit of about 12,950, which again is going to flow over to the retained earnings section of the balance sheet to accumulate the profits that are earned not only in this year, but also in the subsequent years to come. Very important concept in accounting is the difference between the cash method of accounting and the accrual method of accounting. Two different bases. The easiest to understand is the cash method, and in the cash method, you recognize the revenue when you collect it in your hands, right? And you recognize the expenditures when the cash goes out the door. Okay, most people can grasp the concept of the cash method because they won't make an entry in, for example, a system like QuickBooks unless money comes in or money goes out. So the cash method is the easiest to understand, but the difficulty with the cash method is that it doesn't really show you the true picture of a company. And that's where the accrual method comes into play. The accrual method is more comprehensive in that it measures the revenues when they are earned and the expenses of an organization when they are incurred. So let me give you an example of what that means. So revenues when they are earned. You may sell something to someone and give them credit terms of, say, okay, you'll pay me in 10 days, 15 days, or 30 days for this item that I just sold to you. Well, with the cash method, you wouldn't record that transaction because you didn't get the cash in your hand. In the accrual method, you would record that as revenue because the earnings process is complete. The earnings process, meaning being complete, is that you have handed the good over to the person, they picked it up, and they have agreed to pay the money based on whatever terms are applicable to your company. And so, and the opposite of that is on the expense side. On the cash, as I indicated, on the cash method, you're only going to record the expense when you actually either write the check or pay it in cash. Whereas on the accrual method, you would actually record the expenditure when it's incurred. And what does incurred mean? A really good example of incurred is many of you will establish relationships with your vendors where, again, you may have a lenient credit policy with them where they might allow you to pick up goods and utilize those goods for selling, and you don't have to pay them for 10, 15, or maybe 30 days. If you could get it for 60 days, good for you. But nevertheless, once you go and you pick that good up from your vendor, you would have to record that as an expenditure on your books. Just using an example for inventory to be sold. Once you pick that inventory item up from the vendor that you usually deal with, you would actually have to record that expenditure on your books using the accrual method. So just to summarize, really, cash again, whenever it touches your hand or leaves your hand is when you would report it. And with the accrual method, which is more comprehensive and provides a better understanding of how the business is doing from a revenue and expense standpoint, the revenues are reported when they are earned and expenditures when they are incurred. So I'm going to stop here and turn it over to my colleague, Ms. Annette Williams, the CFO of the bank, and allow her to delve a little deeper into some other components. Annette. Oh, you're on mute. There you go.
I got it. Sorry about that. Thank you, President Collins. To continue the conversation about cash versus accrual, in order to properly recognize your revenue when you sell goods on credit, when you give your clients or your customers the opportunity to pay it in 30 days or so, we established on our balance sheet something called an accounts receivable. And that represents money that others owes to your business. It represents any goods or service that you sold on credit to the client, to your customer. And that is recorded as an asset on the general ledger. And it is caused by selling goods on credit. So what happens is that because you're not receiving the cash at that point, you still do get to record an asset on your books, and you are allowed to record the fact that you sold, so you have that revenue. So the entry would be that you establish an accounts receivable as an asset. Now, when the person pays, then you get the cash, then you'll increase your cash account, and then you decrease the accounts receivable balance that you owe. And then on the other side of the balance, on the other side, when you go out and you purchase inventory or you purchase equipment for your business, but you do not pay at that particular time, an accounts payable is established. So an accounts payable is money that the business owes to the vendor, the suppliers. You would have bought goods or services, and so you have to record a liability on the general ledger. You have to show that you owe those funds to someone, and the transaction is caused by purchasing goods on credit. Both of these are called current. The account receivable is a current asset, and the account payable is referred to as a current liability. And that means that a really short-term is a short-term asset or it's a short-term liability. The expectation is that it will be something that will be paid up or received within a short period, usually 30 to 90 days. It's not a long-term asset as a building would be, but something that it will be on your books for relatively a short time. Could we move on to the next slide, President Collins? This slide talks about journal and general ledger. It shows the difference between the journal and the general ledger. The journal is a chronological record of all financial transactions of a business. You are encouraged when you have a business that you journalize or you record every transaction, no matter what the transaction is. You should make a note of it. You make sure that it is included in your journal. It is included as part of your business records, your business accounting records, that is. So, and the entry should include the date, the accounts affected, and the amounts that are debited or credited. And this is used to initially record transactions before they're transferred to the general ledger. Now, President Collins did touch on the fact now that we have all these fancy software that does this for us very easily. I remember the days when we used for journal entries and general ledgers, we used to use green bar paper to make sure that we do this manually. There is it's now easier to do that. So the items first go into a journal, it's journalized, and then it is transferred to the general ledger. And so the journal will have the details, like it will tell you if you have an accounts receivable, it'll tell you at what point the accounts receivables were generated. However, on the general ledger, it gives you one number for accounts receivables. So you have, if you have 5 customers who owe you $25 each, and then on the general ledger, you'll just have the total of all those 5 clients. So a general ledger is used to document all financial transactions of a business. They contain individual accounts for asset, liabilities, equity, revenue, and expenses. And it is used to summarize all transactions recorded in the journal, and it gives a complete overview of the company's financial position. So the general ledger is like the summary of your financial position. So the journal is a way to keep track of all inputted information or data regarding a business to allow for the books to be properly balanced. And then the general ledger is usually the main record of accounting that the business uses. In accounting, we talk about double entry accounting, which means that when one account is debited or credited, you have another corresponding account. So there's always 2 sides or two accounts or that gets touched whenever there's a journal entry. I'm sorry. Could we move on, President Collins, and let us talk a little bit about budget? Budget is, creating a budget is really, really, really important. For us, budget helps us to track income and expenses. It enables us to make better decisions, and it aids in setting financial goals. A budget in the business world is like a plan of action. When you are in business, you should have some sense of what you want to do, or how much revenue you want to produce, how many, and at the end of the day, you want that net income figure. Once you've paid everything, you want, once you've taken care of all your expenses, you want to be left with a net income that you can then pay yourself. And so budgeting helps that because you sit down the steps to creating a budget. You're going to sit and you're going to list all the expenses, include any fixed assets. You're going to differentiate between the wants and the needs. So you're going to make sure that you include all the importance, what you really and truly need. You should be setting realistic financial goals. I mean, we all want to make a whole lot of money, but the goals that we set should be realistic. And we need to be looking at our budget regularly, and adjusting it if necessary. Budgets shouldn't just be prepared and sit there. We should be occasionally, monthly if possible, looking at where we are in relations to our budget, checking out the variances. Now, many times you are going to not hit your budget, but you should know that you're not reaching your budgetary goals. And so you should be able to, at that point in time, adjust your spending, increase your sales, but you need to understand the variances between your budget and what you're actually doing. So for budgeting to help, you've got to look at your budget. You have to compare what you're doing, what you're actually doing to your budget. So benefits of budgeting: it improves financial awareness and discipline. It reduces unnecessary spending, and it helps in saving money for emergencies and future goals. So all of these things we should be looking at when we are looking at our actual and where we are, because you might look at your actual and you say, okay, I'm making money, that's it. But if your budget is if your goal is to do something different or do more, then you should, at that point in time, look at where you are and make any changes that you have to make in order to hit those budgetary goals. Could we move on to the next further then? Payroll. Yes. So as part of owning a business, there will be the need, or maybe the need, to have employees. The accounting process requires that you properly calculate any payments due to employee for a specific pay period. You also should make sure that not only that you're recording what the employee earns, but any deductions in their payroll for taxes should be properly recorded. So your accounting system should have a means for properly calculating deductions from your earnings, and also preparing payroll checks or direct deposits, and record payroll information to the government. This process is very important because it is easy, or we sometimes see where we have our employees, we pay them, we make the deductions, and then we do not follow through and report that information to the government. This catches up on us later down, and the government is sometimes not sympathetic. There are fees and fines and all of that stuff when we do not follow proper payroll reporting. So this is important to make sure that if you have employees, that there is an accounting system in place that properly accounts for payroll transactions. So a well-designed payroll system achieves two goals. It collects and processes all information needed to prepare and issue payroll checks and generate payroll records needed for accounting purposes. And we're going to move on to auditing. Audit, I'll start with the definition as recorded there. Is an independent examination of all a company's financial records, transactions, and statements by an external auditor. The key word here is independent examination. So an audit is usually and should be done by someone independent of the business. So I should, as an accountant, shouldn't be auditing my husband's business. We should be hiring, or he should be hiring an accountant who is not related to him. And so this independent examination, it ensures the accuracy and reliability of the financial statements. You do have a balance sheet and you have an income statement. That is something that is produced as part of your accounting records. But there are times when we need to make sure that that balance sheet and that income statement is correct. The bank needs it. There's other needs, persons who want to make sure that the accuracy of the numbers on those statements. It verifies compliance with accounting standards and regulations. Audits sometimes detect and prevent fraud and errors. They do. And they provide assurance to stakeholders. So whoever you are providing, giving these, or even for yourself, there's the balance sheet and income statement, especially if you're preparing it yourself and you want somebody to make sure that it is you're doing it correctly, then having that independent examination of your records is key. The benefits, it enhances financial reporting credibility, provides assurance to investors and creditors, and it improves transparency and accountability. And before I leave, I just want to say that, just give a plug for us accountants. We are here to assist persons in making sure that their records, their business records are accurate. And so in your budgeting process and in looking at your goals, I believe that I recommend that you identify and budget for utilizing an accountant, especially if this accounting stuff is a little bit daunting to you. Having good accounting records, making sure that you file payroll taxes on time and all of that stuff, that's important in ensuring that you are successful in your business. Thank you, President Collins. I pass it back to you for your final comments. President Collins, I think you're mute.
I don't see any questions in the chat as yet.
Yes.
Q&A.
Thank you for this opportunity. We are available for any questions around the fundamentals of accounting.
Okay, so persons in attendance can place the questions directly in the chat. If you do wish to come online and unmute your mic, just raise your hand and then we'll definitely let you have that opportunity. So here's our first question. What is an estimated cost to hire an accountant?
I think from my standpoint, I've seen anything, anywhere between $1,500 to about $5,000. And that all depends too, because if if the accountant is basically hired to help you compile the information and make sure the information is accurate, that's going to be on the lower end of the spectrum. However, if you're also looking for services relative to what Annette was talking about, which is the payroll reporting to a governmental entity, while you may have the software, because once again, QuickBooks also has a payroll subcomponent within it that can help you, pay your employees and run reports. But if you hire someone to double check that your reports are accurate, that you're sending to the BIR or the Department of Labor or what have you, that's going to cost a little extra. So I'd say between $1,500 to about $5,000 is what I've seen.
Yeah, thanks for answering. We have another question. Can you review the pros or cons of using cash versus accrual accounting?
Sure. You know, the pros of cash is that it's very easy because it's based on um money, money that you receive in hand or money that goes out of hand. It's very easy intuitively as a business person to remember to record those instances. It is not so intuitive, you know, on the accrual side. So cash basis accounting is easy, but the con is that it doesn't give you a comprehensive uh, overview of the business as the accrual-based accounting does. So it's almost the flip side on the accrual side, in that accrual, you have to remember that all transactions, no matter if it's transactions where you receive money or um you know or money goes out the door, there are a lot of transactions aside from cash in and cash out that need to be reported in a timely manner. For example, at the end of every month, you may have to what we call accrue your payroll expenditure, okay, or accrue your tax expenditure. Those are additional entries that uh, are that are not necessarily cash related at the time, but will become cash related eventually. And so the pro of accrual is it shows you a comprehensive picture of your business. The con is that it requires a good fundamental understanding of when the earnings process is complete for revenues and when expenses are actually incurred for expenses.
Okay, thank you for that. I have two questions along the same line. What are some payroll softwares available and what payroll apps you would recommend?
Well, if it wasn't obvious to everybody, I'm really into QuickBooks. I think it's the most simple and intuitive program that's out there. I've been using it since 1991. And it's only gotten better. It's gotten better from the standpoint of not only does it do your financial statements, but as I've indicated, they have a module that does your payroll. They have subledgers that do your fixed assets and that account for your inventory. So it is really the most it's a real complete program for the amount of money that's being charged, and it is very inexpensive in comparison to I hate I hate to say this, in comparison to hiring an accountant. um I also utilized a program before called Great Plains. I used to use that quite a bit, but that's for medium-sized businesses. uh, but it is also very simple. It does have more modules associated with it. And what I mean by modules is things, depending on the size of your business, you may want a module that goes into levels of details about your fixed assets, levels of details about your inventory, um, levels of details about the liabilities that you're incurring on the accounts payable side. I'm not saying that QuickBooks doesn't do a good job of it, but Great Plains is a program that actually does a superior job of it, and it's actually quite intuitive. Those are the two that I'm familiar with. I'll pass it to Annette if she has any other software packages.
I don't. I too have used QuickBooks for my nonprofit organizations that I have been treasurers for, and so I QuickBooks is it also for me, yeah.
You know, I would say that there are some businesses that use Quicken, which is different from QuickBooks, because Quicken is typically to manage your personal assets and liabilities. However, I have seen businesses use Quicken before, but it is not as robust as QuickBooks.
Okay. So we have another question. QuickBooks payroll software is a bit cost prohibitive for a small startup with less than 10 employees. Are there any other products on the market?
I am not familiar with any other software, payroll software that I trust at this juncture, but I'm happy to ask Annette if she knows anything for less than 10 employees.
I don't. Fortunately not. No. And this is where, and this is where, you know, an accountant could probably help, because I know QuickBooks has the accountant version, and so they are able to track the transactions for multiple clients. So that may be, in this case, an option to outsource the payroll.
Okay, that seems to be it for questions. And if you have questions, you can go ahead and still put them in the chat. But in the interest of time, let's advance to the next slide. And so I just want to say the VIS BDC has so much more in store for you as VI small businesses. You can visit our website at www.visbdc.org. Download the VIS BDC app on your mobile device from the appropriate app store. Like and follow us on Facebook, Instagram, Twitter, Google Business, and subscribe to the VIS BDC YouTube channel for new uploads of our on-demand webinars. Here's a preview of some webinars that we have on demand that you can watch at your leisure. We have developing a business plan, understanding personal and business credit, establishing and repairing credit. And we also have First Bank, and they're going to be presenting this Friday. It's a webinar on the fundamentals of business credit. We have, oops, sorry. Just a second. So outside of this Friday, we want to mention in May, we will make an appearance at the Virgin Islands Boating Expo. On May 14th, we have SBA resources every small business should know. On May 21st, we have securing a SBA loan for your business, how to get approved. On May 23rd, we have VI Apex, and they'll be presenting on women-owned businesses certification, questions you want to ask. On the 28th, we have Ascent by SBA. That's a women entrepreneurs program. And on the 30th, we will have VI Apex back again. And they specialize in government contracting. They're going to be presenting on responding to RFPs, RFIs, and RFQs. So those are a few webinars that we have coming up. I don't see any questions. So I do believe that it's safe to close. Here's a friendly reminder that this webinar will be converted into an on-demand format. So you're going to be able to log in and re-watch the presentation. There's going to be a survey emailed to you immediately after this webinar. Please take the survey, let us know how we're doing, and we're going to attach a copies of today's presentation as well. So on behalf of the entire VIS BDC network, Merchants Commercial Bank, it's always a pleasure collaborating with you guys to bring information to our small business community as well as the general public. Thank you for your time. And everyone, do enjoy the rest of your day. Bye, everyone.
Thank you.
Thank you. Bye-bye.